longest time, everyone has said the following, which is that India is a great story to be in. The economic contours are in place, but valuations which is a concern. Could you throw more light on it? That if one is looking at projected returns from these levels, where multiples above the historical averages, what should one expect in terms of 2 to 3 returns?
Okay. Obviously, this is a question which is always present for Indian market. It's not just if you go back 1 year, we would have the same debate. But I would say let's understand valuation from few benchmarks point of view. And that makes it easier where we are. When obviously at index level, look much more palatable, but there's excess on one side and depression on one side. But let's put some numbers in context. Like if you look at a bit of a crisis like valuation for India, that is about 11, 12, 1 year forward PE. And if you look at 5-year average is about 19, 20 now. And if you look at a bit of a depressed valuation for India when things have gotten bad, macro is bad and earnings have misses, we bottom out about 16, 17 the current time. We are at about 21 times, right? It's about 7-8% premium to, it's 5-year average. But I would argue that India's structural investment case has risen in the last 3-4 years. Earning growth has been very resilient. One of the things we really ignore is that how reasonable the inflation expectations have been, which has been a part of problem for India. Inflation trajectory has been much more stable. GDP growth rate stands out, and also even in a context where fiscal is also consolidating, rupee is going to be stable. We don't get that context. So if there is some premium to past, it is not. I would argue that it's not a very large premium, and hence you may experience some events which impacting in valuation a little bit, and that's the reason those phases are very shallow. So although valuation at some level has its own excesses, but at the market level, I would argue that it doesn't have as much stuff as people would imagine. So in that context, small corrections become a good window where FI flows return and market rebounds back. So that phase we are in. We are in a volatile market. We have so many unknowns. So we expect phases of consolidation to reappear again and again. FI flows are negative on a daily basis, for example. But at the same time, that position reverses also very quickly. And as how earnings shape up, that would shape the market, to answer your question as well. Multiples are here to stay. Multiple can expand also a bit. But I think the good part is that earning expectation that we have for FY25 is about 15 odd percent, 14, 15 odd percent. I would hazard a guess that, it's much more credible how the earnings are shaping up. So if the earning downgrade risks are lower, I would say that one could expect that multiples to rotate very easily, and at least earnings should compound into the stock returns as well.
Curious to know what are your sectoral underweights and overweights at this juncture?
So, it's a great question because, so for example, if I were to look at some of the sectors we like, some of the sectors we like are, for example, specialty retail, right? Where we see, great momentum, great earning growth, also some sort of momentum is, earning and operating outlook. Even FI flows, if you look at, they are disproportionately favoring, for example, that sector as well. This is part of that, by the way, travel, luxury, retail, etc. So that space is very exciting to us. Auto is also something we are very positive. Industrial space, we are very positive. We also like, for example, even telecoms as a sector which stands in our sort of framework. What we also see, healthcare is well placed for now. It may have its periods of bit of consolidation, but healthcare continues to be well placed. What we, for example, see two sectors as a risk-on sector, where banks is sits, for example, wherein operating outlook is a bit challenged because NIM pressure and all those debates will continue. But I think it is slipped to, for example, in our framework, slipped to a zone where we call risk zone. And I think whereas the business dynamics, even semblance of improvement, stocks will experience reasonable rallies there as well. Banks is something we are positive. Even selectively, I would argue although revenue growth outlook for IT sector is quite still challenged, but at the same time, that sector also stays in the market. Marginal improvement there would also spring up as a surprise. We continue to be a little cautious on FMCG names. So we have been cautious since September last year. we continue to maintain that caution because the demand outlook is a bit uncertain. Valuations are reflective of the past. So we see some of rebalancing happening there. But overall, that's the kind of contour on the sectors.
If you like this video, then like, share and subscribe to ET Now.